Hello and welcome to Quarterly Context webinar for the second quarter of 2018 for clients and friends of the advisory group and WealthStep. WealthStep is the division of the advisory group that provides simplified service for up-and-comer individual clients as well as 401k plan advice for participants. Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal and institutional clients better achieve their goals. We try to keep these meetings to about 20 minutes, and we'll circulate a video link afterward should you like to view some portion of it again or pass it on to someone you think we can help like we've helped you. If you have any questions, please submit them to the question box, and we look forward to any questions you might have. The high-level reminder in terms of goals is to focus on what matters and what you can control in terms of what you desire versus require in short-term and long-term. And please always have this discussion with your advisor here at the advisor group to help make sure your specific goals and needs are addressed as they change and evolve. In terms of markets, it was mixed for the quarter, with the U.S. market surprisingly resilient despite some volatility. International and emerging market stocks were weak and very weak, with emerging down almost 8%, in great part due to dollar strength and Fed policies around the world. Real estate was strong, especially despite continued rate increases, and bonds were mixed with U.S. and bonds slightly down, international bonds up about 0.5%. Interestingly, for
The broadcast is now starting. All attendees are in listen-only mode.
Emerging markets, for example, mentioned that they were down 7.9%, but still over a full year up right at about what the long-term projected return is, or a little above it at 8.2%. In terms of some notable elements regarding the markets and the economy for this last quarter, Fed raised rates 0.25%. There were concerns about trade wars, which really affected both stock and bond markets to some degree. But still, markets were surprisingly resilient given all of that trade war talk. The higher rates led to the short-term treasuries sharply up to 2.52%, which was the highest since 2008, from 2.27% earlier in 2008. You can see here the yield curve, which shows the yield along the different bond maturity spectrum, has been flattening as the short end of the curve, rates at the short end of the curve with Fed rates has gone up, while longer bond rates have stayed the same despite a little bit of inflationary pressure. When rates flatten, that is an implication generally of impending slower economic growth and inflation. And if shorter term rates are higher, become higher than long-term rates, by them shorter going up or longer coming down, that's called an inverted curve. That's not the case currently, but if that happens, it implies some recessionary elements. In terms of a few other elements about stocks, one notable element in the one of the old standard indices was that GE was removed and replaced by Walgreens. Overall, markets, despite some of the volatility, were relatively strong, in part due to strong earnings. Financials were hurt, however, financial companies hurt by the rate curve shift. And for those that sometimes wonder about gold, it was down 5%. So gold is not always an easy ride. And as we've mentioned in a few presentations before, actually loses against inflation in the long run. The news of the recent quarter is shown here. Lots of bumps up and down, lots of questions of trade war discussions and threats, and pulling out of the Iran deal, and a number of factors. There's always something that will bump the markets around in the long run, but tend to not have a major impact. In the short run, but tend not to have a major impact in the long run. Looking at a few of the economic details, growth was fairly moderate at 2%. However, the expectations for the next quarter after the Q2 numbers come in is that they'll be closer to the around the 4% range, which would be relatively strong. As we mentioned, rates going up a little bit. Additional rate hikes are expected, a few more in 2018 and 19. Inflation has now hit a 6-year high with headline CPI at 2.8%, and the Fed hitting the Fed index they most closely monitor and use as their benchmark, the PCE, or Personal Consumption Expenditures Index, hit 2% the first time since 2012. Unemployment fell a little bit further, lowest since 2000. Wage growth was up a bit, but still below the low-term average, but a lot of that wage growth increase was offset by the higher inflationary numbers. So the real impact of earning power for the average person is not yet increasing materially. Consumer confidence remains high and increasing, although it cooled off just a little bit. And oil has been interesting, bouncing back and forth with OPEC deciding to curb oil and then relaxing that, or saying they will, and voices in Washington pushing for more output and lower to create a supply-demand effect that would reduce oil prices. Taking a look at some of the long-term charts of some of those numbers, you can see here that wage growth number that has been creeping up, but still with inflation going up, that's been offset. Unemployment here, the consumer sentiment has been hovering around a relatively high space relative to this blue line average, but cooled off just slightly probably given some of the recent market volatility in the last quarter or two. Oil has been picking up speed, as we mentioned as well, and corporate earnings, as mentioned, relatively strong with projected earnings continued strength. That provides some support for market valuations despite some of the volatility. This chart is updated to show the 4 worst markets and their recoveries, and the blue line is the global financial crisis and recovery, which even on an inflation-adjusted basis is far ahead of the other 3 worst markets. However, some volatility, as you can see, has picked up here, and it wouldn't be uncommon for some reversion to the mean after to more normal levels of returns that may be happening now with some sideways markets. As mentioned, with interest rates going up, 7 quarter point increases since the end of 2015, some are wondering what the implications are and the degree to which they should be concerned. Because rates are expected and have been clearly forecasted in terms of increases, a lot of that is essentially already priced into the market. And here on this chart, you can see what the Fed's expectations of rates are. And here you can see what the market expectations are. So the market doesn't expect the Fed to actually raise rates as much as they currently do, which implies that investors believe that the economy may be cooling a little bit and the Fed therefore may pull back on their rate increase plans. So rising rates push bond prices down, and that's more direct for short-term bonds and indirect through inflation management by the Fed in terms of long-term bonds. But it's important that investors remember that while that short-term volatility in bonds isn't pleasant when it does happen, over time, the higher yielding bonds that are coming onto the market that relate to those higher rates increase bond portfolio yield and portfolio returns. So there is a benefit over time. There's an inset chart here that is, of course, impossible to read due to size, but what it shows is that when bond yields, which relate to rate increases and decreases over time, but when bond yields are 5% and rising, it tends to be more associated with negative stock market periods. Now, rates are rising with these 10-year Treasury yields currently just under 3% versus this 5% in this chart where that line is drawn here. However, a key question is that with the low growth environment that we're in and expect to be in, this 5% marker may overstate or may not be the right line to draw. It may be that this line would be pulled back closer to a lower number at the point where it might have a more negative impact on the stock market. In terms of valuations, just summarized by showing here that current valuations relative to the price earnings ratios of the last 25-year averages, these are right more or less on the mark, with the exception of Japan, but right around averages, just slightly below, given some of the volatility in certain markets. You can see the volatility in the markets through the VIX index has spiked earlier in the year and has still remained a little bit higher than recent years, but cooled off a little bit. VIX is oftentimes also referred to as the fear index. In terms of quality for the quarter, when we refer to quality, in this case, we're talking about stock ratings, which oftentimes relate to higher quality companies, for example, having stronger balance sheets, better debt to equity ratios, which tend to have less volatility in difficult markets, but a little bit less meteoric rises in hot markets. And we've been in a pretty hot market for a pretty long time now, about 10 years with a few exceptions along the way. And you can see here that what's shown as red means that higher quality stocks underperformed by the amount shown in the different quadrants, from value on the left to growth on the right and large on the top to small on the bottom. So it just gives you a visual picture of whether that currently lower quality stocks are outperforming or conversely high quality stocks are underperforming their low quality brethren by these amounts. For the year, similar with a few exceptions. And then in this chart, periodic table of quality, we could call it, shows that for the last 10 years or so, the blue boxes, for the most part, have been hovering in the bottom half, with a couple of exceptions when markets got a little bumpy. This is cyclical over time. 10 years used to be a long time period, but we're in an extended cycle now, so it's hard to say what a full cycle will be, but it tends to average out over time. In terms of mutual fund industry cash flows, same story in general as usual. A lot of investors using the back rearview mirror to make decisions moving forward. Money's been coming out of cash and getting pumped into bonds, given some of the volatility, also at a time when rates are going up and creating volatility in bonds and some market net outflows out of U.S. equity. So that's not indicative of a disciplined approach on average, and the disciplined approach tends to have better outcomes in the long run. In terms of behavioral finance, a lot of information here, but we've gathered some information, research that suggests that unconscious biases can really impact decision quality. A number of studies here that aren't directly related to finance, but that can and have been tied back to a lot of different financial behavior as well. For example, inaction bias is the tendency for people to continue doing whatever they're doing when things are going well, even if they might be better off changing course. An example of that is not rebalancing a portfolio to maintain a risk profile. The brain is more concerned with losses than gains, and so when one example of that is that sports teams tend to fire their coaches too soon, and data shows that that actually does not correlate with success. People tend to be more focused on those recent outcomes than what the statistics are about and real probabilities about what actually does work over time. There's lots of examples that we've shown you before, happy to show you again, about investment manager, mutual fund, and separate account manager hirings and firings by both individuals and fiduciaries, and a similar pattern shows up there in terms of what's effective and what's not. Action bias is that a lot of people tend to take action when things are going poorly instead of being disciplined. Certainly there's some cases where that could make sense in life, but sometimes if it's cyclical and you are doing something that gets you out of the market or a manager at the bottom, oftentimes that is just giving up the recovery cycle. So not a new theme, but different research that reinforces the same ideas we may have mentioned to you before. Interestingly, getting burned tends to reduce one's sense of stability and causes people to make more short-term, less patient decisions over time. You can imagine lots of financial cases where that would be the case. Reduced objectivity is another unconscious bias, where sometimes referred to as the IKEA effect. There's lots of interesting research that when people build something themselves from IKEA and then sell it, they tend to try to sell it at a price that's much higher than if they didn't build it themselves. So there's sometimes people stick with their plans instead of using getting objective help to find a more effective plan. Given the World Cup happened recently, we thought we'd also include a soccer research study. So this study showed, as is illustrated in this chart here, that goalies during penalty kicks make decisions partly unconsciously out of the criticism of their effort. So whereas statistically 29% of shots actually get shot into the middle of the goal zone, goalies only choose to stay in the middle 6% of the time. And the research and interviews suggest that goalies believe that their coaches and their fans will think they didn't try if they just stay in the middle, whereas statistically they would actually decrease goals by having a more distributed decision of where they choose to stay during a shot. So the key of all of this really is to be aware of what unconscious biases might be affecting you. Ask your advisor to help you think that through, and what other specific things that they might notice that might be helpful to you, and focus more on long-term strategies. There are also an array of suggestions and research around 401k plans and other self-directed plan fiduciary elements in terms of well-being being affected by misperceptions about aging. This is also very helpful if you have children or adult children that you're trying to coach in terms of making better financial decisions. So one of the biggest patterns is that people tend to be self-interested, which is just a general human trait, not 100% always, but to some degree, that's a survival mechanism. And they view the future self as a different person, not themselves. So they tend to therefore then take action that relates to their current needs more than their future needs. So if you can help create a connection with the future self, there's a few different methods, and we've talked before about an aging app that will take a picture of you and do a computer simulated aged image that studies show can be helpful. and talking about the future in a different way, helping people understand that the future self needs their help, can really help move that needle. There's other research that suggests that people overspend and undersave in their accumulation years and do the reverse in their retirement years because of the perception of age. Younger people tend to be more optimistic about reaching less optimistic about reaching age 95, and older people less optimistic. So that has implications with planning, and we're having those conversations with clients somewhat regularly now to help shape that out and create a more effective view. People that are optimistic tend to believe that death will be caused by natural causes, where less pessimistic people believe that non-natural causes are more likely. And interestingly, optimists save more, whereas pessimists tend to have more credit card debt and struggle economically. So all of these things are helpful. And for 401k plan clients, we can go through with you individually some of the specific recommendations to help outline this. But as it turns out, a lot of these elements that are the recommendations by experts can be addressed in great part through the use of a tool like WealthStep that we'll be rolling out in the not too distant future. Won't go through the details here on foundations and endowments. We'll just summarize by saying that as size decreases, the asset allocations tend to be different because of different access and patience and flexibility levels. And over the last 10 years plus, the spending policy rates have trended downward as capital market expectations have trended downward. In terms of rules and regulations for the corner for the quarter, the additional erosion to the Consumer Financial Protection Bureau, Social Security is hitting some challenges and has now been forced to dip into the $3 trillion trust fund. And without additional action by Congress, the reserves would be depleted by 2034. And starting in 2034, people would receive 75% only of their current projected benefits. In terms of general changes, the fiduciary rule has now formally been terminated by the Fifth Circuit Court. However, the SEC has proposed a new fiduciary rule for retail investors. So that may provide some support for consumers in general. There's a number of elements regarding out of Washington that would further reduce financial regulation that can improve stock prices for stocks, but can be harmful to consumers. And in general, long-term trends would suggest that reduced financial regulation can increase market volatility and the chance for more dramatic financial crises. So something to be aware of. And then for fiduciaries and retirement plans, maybe the most notable news was that fiduciaries, there's been debate back and forth over time about social investing or using funds or managers that have environmental social governance or ESG factors, that fiduciaries should be careful not to overemphasize ESG factors when selecting investments, and that they really should, fiduciaries really should focus primarily on economic outcomes. Now, one thing we've talked about in the past as well is that non-ESG specific managers, traditional investment managers, are using more ESG factors purely for economic reasons. So there is a bit of a convergence in the industry, although it varies a lot by manager. But we can talk to you more about that specifically. We're making progress with WealthStep, have completed the formal beta testing stage and received a lot of positive feedback from testers about the helpfulness of the tool for 401k participants and smaller individuals in terms of helping understand what amount of savings they will need to begin retirement, how much they will need to save now, and how to invest to make those three different elements work to increase successful outcomes. We'll provide more information on that, and when we plan to launch it, as soon as we have more information. As a reminder, in terms of value added, there's a 5-step process we use on the investment side, and then also wealth and life strategy planning, spending policy, and other areas use similar type processes. The idea is to analyze, design, formalize, implement, and monitor using a process orientation around the client's needs rather than a product information trying to force a square peg into a round hole. Of course, this approach is conflict-free and entirely designed around benefiting the client. So thank you for your time and attending. Please always let us know by email or in phone or in-person conversations what we can do to serve you better. What's the one thing we can do to be more helpful in supporting your goals? And we look forward to interacting with you soon.